Good evening, everyone. Thank you for your patience. My name is Glory, and I am the lead consultant of Fields Africa, and welcome to today's webinar on taxation for SMEs. So we started a bit late to give people time to log in, but I think we've given enough time. So we'll be kicking off right away. I'd like to introduce kolawole Olashile. He's the presenter for today, and I would like to hand over to him now.
Okay, thank you very much, Glory. Good evening. My name is Kola Olashile, representing Standard Practice Professional. So today I'll be speaking on tax as it affects SME and as it's, and again, alongside with the finance bill that was just signed into law in effectively February. That will be the scope. And the agenda for today span across about myself, tax and how to navigate, bodies that administer tax in Nigeria, business vehicles and tax impact, compliance for startup and SMEs, existing tax laws, just an overview, and changes in the tax law based on the finance bill that we just signed into law. Not everything, but as it affects SME, basically. So that's my humble self. I'm a founding partner, Standard Practice Professional, an associate member of the Institute of Chartered Accountants, ICAN, a member of the Chartered Institute of Taxation of Nigeria, and an MBA from Lagos Business School. Okay, so what we have here basically speaks to an overview of tax and is how to navigate in this economy for SME. Basically, we have, I can put it in this perspective that we have corporate tax, we have personal income tax, we have various kind of tax laws, we have capital gain tax, we have value-added tax, we have quite a number of them, and the administrators of these taxes spread across the Federal Inland Revenue Service. These names are not new, and Internal Revenue Service. So the Internal Revenue Service relates to the revenue services for respective states in the Federation, while the Federal Inland Revenue Service is responsible for the tax administration for the federal government. So every state basically have its own internal revenue service. So for instance, Lagos State Internal Revenue Service is Lagos State Internal Revenue Service, which is LIRS. And Ogun State is Ogun State Internal Revenue Service, which is OGIRS. You know, likewise, we have similar IRS like that in every state. So what these guys does and what they administer, we will see that in subsequent slides. What they administer differs from each other, and the respective tax laws that they try to manage and administer differs from one another. Again, in this overview on how to navigate the tax laws in Nigeria, like you can see in the pictures that you have right there, yes, there are laws which must be respected and must be obeyed. There are sanctions if you fail to comply and to abide by those laws. But again, do we really want to be on the wrong side of the law? The answer generally should be no. Just like we have the law, we have the arbitration section also, which is a legal unit that also help to find the middle ground between the taxpayer and the government that is trying to administer the law. So what am I driving at here? I'm saying that basically try to, as much as possible, to comply with the law. We can manage taxes effectively without having to go against the law. And that starts from proper bookkeeping. Proper bookkeeping for a business helps in a long way to manage tax. Failure to keep proper books exposes the venture, the business, unnecessarily to tax, leading to penalties, leading to sometimes I've seen situation whereby business SME have to close down because why? Because they cannot just afford to pay the penalties and fine as a result of not knowing what to do or what should have been done or what the law is really saying and all the rest of it. Again, on the last side of this, the good side is that you can actually make money back from government easily by managing your tax properly and effectively. So, and that again is born out of proper bookkeeping. Proper bookkeeping. So most of what I'll be talking about today will have a background on proper bookkeeping, because it's only with proper bookkeeping that you can actually have uh, a fair exposure and you can manage your tax effectively. So I think I mentioned this earlier on. The Federal Inland Revenue Service as the administrators and the State Internal Revenue Service, just a sample, Lagos State and Ogun State. What taxes do these guys administer? Like I said earlier, we have various tax acts. Personal Income Tax Act is there, Company Income Tax Act, Value Added Tax Act, Petroleum Profit Tax Act, Capital Gain Tax Act, and these are various taxes, and there are other form of taxes that are embedded within each of these acts. For instance, withholding tax. Withholding tax is not an act on its own, but it is embedded within Company Income Tax Act. So, but we'll see how all this play out eventually and how it affects SME as we move on. So, speaking to the business organizations. So I'll be limiting myself to these classes of businesses that we have around. So limited liability company, business name, cooperative societies, ecclesiastical charitable organizations, and partnership. For a limited liability company, well, for those of us that were part of the webinar with the legal person the last time, I don't want to start going into the basis of business, but I will just talk about the tax and how it affects them as we move on. So for a limited liability company, it's a company that is limited by shares. It could be a public limited liability company and it could be private limited liability company. Now, basically, this company is administered for tax purpose. The tax that administers this company is the Company Income Tax Act. Now, coming back to this particular slide now, Company Income Tax Act. And as you can see, Company Income Tax Act is under the Federal Inland Revenue Service. So by default, if you have a limited liability company, you are expected to be compliant with this list of taxes that I've listed below it: the company income tax, education tax, value added tax, withholding tax, capital gain tax, personal income tax. These are taxes that borders on a limited liability company, either public or private. For a business name, the business name holder and the business name venture are just the same thing. So when it comes to business name, you are not exposed to some things as being exposed under the limited liability company. So we have Personal Income Tax Act. You are exposed to Personal Income Tax Act. You are exposed to value tax. You are exposed to withholding tax. You are exposed to capital gains tax. For a cooperative society, you are exposed to personal income tax. You are exposed to value added tax, withholding tax, capital gains tax, ecclesiastical charitable organization, that the churches, the mosque, and the rest of them. You are exposed to personal income tax. You are exposed to value added tax, withholding tax, and capital gains tax. And partnership. Partnership is just more or less like a business name of ventures also. The respective partners within the partnership are exposed to personal income tax, value-added tax, the withholding tax, and capital gains tax. So I'll be speaking to each and every one of these taxes here, and I'll just give a kind of an overview. And as we move on in between the slide, we'll see what has changed based on the Finance Act and how an SME should be able to navigate effectively. So a company registered as a limited liability company effectively should start filing, is expected to file company income tax returns on yearly basis. So for your company income tax, the rate is 30%. Well, that's the old rate. Okay, that's the old rate. But based on the new rate, which we are going to see in the subsequent slide, we will see that. So a company is expected to file returns yearly, irrespective of whatever waiver that you must have got, waiver in the light of pioneer status, exemption from paying taxes or what have you that the government must have granted. The law requires that you file. Filing is totally different from you making payment. Now, education tax is 2% of some kind of calculation, 2% of accessible profit. Accessible profit is derived from so many calculations after you must have done your audited account. Value-added tax is actually a rate which is charged on vatable goods and services. Now, every taxable person that carries on taxable business in Nigeria is expected to charge value-added tax. Now, value-added tax is not a tax that is borne by the person charging or the person doing the remittance. So, as a business owner, the law requires you, as long as you carry out a transaction that is a vatable transaction, the law requires you to charge the required rate of VAT. When you charge that VAT, you are expected to remit that VAT to the government on or before 21 of the following month. So let me give an instance. So we are in February right now. So all the transactions that we did in January 2020 that are vatable transactions, and it has been for at every point in time you raise invoice and you charge VAT on it, the VAT so collected in January will be remitted on or before 21 of February in this month of February. So likewise going forward into the months. Now, a lot of people seems to misconstrue this VAT as a form of tax that is borne by the business owner. No, tax is borne by the final consumer. So if you are within a value chain, let me give an instance of an agricultural business, for instance, and you from the farm, excuse me on whether it is vatable or not for now, let's just give an instance. So from the farm, the farmer has produced cassava, and farmer is selling the cassava to the processing plant. Now the farmer somehow will have charged 5% of that transaction. So the farmer will file the 5% of this transaction at the end of the month to the government. Now remember that the person who pays that 5% is the processor who is going to process the cassava. Now, when the processor is done with the processing, it sells to the store that the sales will be made. When it's making that sales to the store, it's also charging the rate of the VAT to that store. Effectively, the store is paying the processor the 5% VAT. Remember, the processor paid 5% the farmer who made the sales to it. Now, the 5% effectively is returning back to the processor. So the processor, when he is filing his own VAT, I have paid 5% to somebody, I have collected 5% from the store. So effectively, the processor is paying no VAT. Now, but it's going to file. The store also will charge the final consumer the VAT. Remember, the store paid the processor 5%. Sorry, don't let me use it because the rate has changed. Remember, the store paid the processor the rate for VAT. Now, the store is now charging the final consumer that rate Now, the final consumer is not charging anybody. He has to just pay whatever rate that is whatever the final consumer is then expected to pay that rate that has been charged in store. When the store is also making its own returns, it says I've paid to the processor and I have also collected from the final consumer, right? The net of effectively is not paying anything just on this single transaction. So who has paid that VAT eventually? The consumer is not charged, it is the final consumer. So VAT is a tax borne paid by the final consumer. Now, withholding tax speaks to an advance payment of tax that the person in which it is deducted from use that consumer, right? The net of effectively is not his liability at the end of the year. So let's say company A has done business with company B. Company A issued invoice to company B. When company B is making payment, especially when that transaction is within the withholding transaction, because we have a withholding threshold transactions. So withholding transactions that withholding tax applies to includes contract, royalty. Company B is withholding rent, service, and some other kind of transactions like that, about 7 of them. So when this kind of transaction unfold and the company A is issuing invoice for those transactions, when company B is to make payment, the law demands that company B deduct withholding tax in the respective rate. So the rate for withholding tax differs based on the kind of transaction and based on whether it is a corporate or an individual that is carrying out that transaction with you. So when you deduct that, you remit to the relevant tax body. So when it's a corporate, you remit to Federal Inland Revenue Service. When it's an individual, a partnership, you remit to the state Internal Revenue Service. Now, this credit, when the company at the end of the year prepares his account and the tax workings, and let's say there is a liability to be paid on company income tax of, let's say, 1 million naira, and you have a total credit of about 500,000 naira, you can use this credit with withholding credit to offset your company income tax liability. Now, it is only company income tax liability that you can offset with withholding tax credit note. You can't offset any other kind of tax liability with withholding credit note. Education tax, you have to pay the cash equivalent. Company income tax is the only tax that you can offset with withholding tax credit. Now, withholding tax also play out, withholding tax play out in another fold in the area of, there are some organizations that are allowed by law to deduct withholding and to deduct VAT. Organizations like oil and gas, the ministries and parastatals. So ministries and parastatals are the only set of corporate and organizations that are allowed to take out VAT and withholding tax at source. So what that means is that when you have business with an oil and gas company, they will not pay you the VAT element of, they will not pay you the VAT that you have charged on your invoice. They will deduct it, remit on your behalf. They also deduct the withholding tax and remit on your behalf. A lot of people have tend to mix value-added tax up with withholding tax. And then that is because the rate seems to be similar, especially with the kind of transaction. So when you raise an invoice, the invoice is 100%. Your invoice is 100%. When you charge the VAT, when it's a VATable transaction, it makes it 105%. When your customer is making remittance, let's assume you are dealing with an oil and gas company. Oil and gas company will then pay you only 95% because they will take out 5% VAT, the VAT you've charged, and they will take out 5% depending on, let's assume the transaction is a contract and they are dealing with, they will take out, let's use a contract, they will take out 10% withholding tax from that transaction. So effectively, they are paying you 85% of your invoice value. So you will get at the end of the month or subsequently, you will get the credit note from them, which you will use eventually to offset your company income tax liability at the end of the year when you file your returns. So capital gains tax speaks to tax that is paid on disposal of assets. So when there is a disposal in assets, you pay capital gains tax. Is a tax that you pay on the gain that you made on that asset. So if the asset proceed is, for instance, 1 million, the cost of the asset is about 800,000, and all the fees and every ancillary cost incurred in disposal of that asset is about, let's say, another 100,000. So you have about 900,000. Cost is 800,000. Ancillary cost is 100,000. 900,000. So you've made a gain of about 100,000 in that disposal. So 10% capital gains tax applies to that. There are other scenarios within the law that plays out under capital gains tax, but on the face value, this is what capital gains tax is all about. Is basically on disposal of a fixed assets. Personal income tax. Personal income tax, as the word, is the tax that is paid on the income of individual. Of course, if you are an employee in an organization, this will be very familiar. It's called payee. Now, this is administered basically by the State Internal Revenue Service. And in Abuja, it's only Abuja that administers, it's only in the Federal Civil Service that it is administered by the Federal Inland Revenue Service. So I'll explain. So every state administers personal income tax. If you reside in FCT in Abuja, it is administered by the Federal Inland Revenue Service, not until about a year or two ago, where FCT Internal Revenue Service was created. So that arm of the administration of personal income tax in Abuja has been moved to FCT Internal Revenue Service. Before then, it used to be administered by the Federal Inland Revenue Service. But the Federal Inland Revenue Service still administers part of this personal income tax for the federal staffs, for federal government staff that like the police, what do you call them now? The Internal Affairs, Ministry of Internal Affairs, or prison, customs, the rest of them. The personal income tax is still administered by Federal Inland Revenue Service. So the only arm that was moved from Federal Inland Revenue Service to the FCT Internal Revenue Service is just for the residents of Abuja. Before, it used to be administered by FIRS, both residents of Abuja and the federal parastatals. That's for the army, for the customs, prisons, the internal, what do you call that ministry now? The internal affairs, Ministry of Internal Affairs. Yes, everything is administered by FIRS before for their staff. But for FCT, it has been moved to FCT Internal Revenue Service. So, having said all this, then I move to the next slide. Here we are looking at income that are exempted from taxes. This has always been there in the tax law, just samples of what we have before. Profit from companies solely promoted for sport activities, profit of trade union registered under the Trade Union Act, profit of company established within the export processing zone, profit of from statutory or registered friendly society, profit from cooperative society, income on domiciliary account, interest on domiciliary account, interest on deposit account of foreign non-resident complaint. Now, there's a clause to this. This interest, this deposit must have come into Nigeria through the approved channel, and the only approved channel is through CBN. So if you are just going to change money as a foreign company in Nigeria, change money and put in your domiciliary, it does not apply. Interest on domiciliary account as a Nigerian, interest on your DOM account is exempted from taxes. Foreign dividend, interest, rent, and royalty. If you have a dividend abroad, interest, if you have property abroad, the rent you get from those property, when it comes into Nigeria through the appropriate channel, that's through CBN, it is exempted from tax. Profit from ecclesiastical activity, charitable and educational activity. Now, I'll speak to these charitable activity and ecclesiastical activity, and I will speak to this cooperative society, and alongside with trade union, and I'll quickly talk about friendly society. So friendly society and cooperative, they are apparently the same, very close to each other. So for ecclesiastical and charitable educational activities, yes, these activities are exempted from the income, and profits from these activities are exempted from taxes. But it does not exonerate this set of people from filing relevant returns with the respective body. So if, for instance, an educational body was registered as a limited liability company, for the fact that you are registered as a limited liability company, you have the obligation to prepare your account at the end of every year, and you file with the Federal Inland Revenue Service. If the educational activity is registered as a business name, you don't have problem with Federal Inland Revenue Service, right? Now, even for the fact that you are filing, it means that your filing does not mean that you are paying tax, because your income is exempted from tax. So when you do your profit and loss and all the rest of it, the tax computation will be computed, all the profit will be backed out, right? And all the rest of it. Now, if you are within this confine of an ecclesiastical activity, a church, mosque, charitable organization, and educational activity, but you do other business, say for instance, you have a printing press. Your printing press, the profit from that printing press is not exempted, is not covered under this window. It is only the profit from the schooling activity, the charitable activity, and ecclesiastical activity that is exempted from taxes. So nowadays we have churches that owns printing press. Their printing press business, whatever profit they made on that business venture will be subjected to tax appropriately, depending on the kind of registration that was done for that business venture or for the business activity. Likewise for the charitable and for the educational operations. So we have some schools nowadays that also have they have other business that they do within the school that are ancillary to the school operation, but it's not within this window of exemption. So depending on your form of registration, if your registration is a limited liability company, you must file that returns and you exempt all those profits that are allowed for exemption under the tax law, right? For cooperative society, yes, cooperative society or profit is exempted from tax to the extent of the cooperative activity. But the moment the cooperative start other business venture that is not within this window, those business venture will have to pay taxes on whatever profit that is made from that business. So same thing goes to the registered friendly society and the trade union. So for trade union that is registered under the Trade Union Act, whatever profit they make under their umbrella of activity is also exempted from taxes. Now, what is new into this income exemption? What is new? We'll quickly read through together. So the profit of a small business in a relevant year of assessment has now been exempted from tax. So now, based on the new finance law, they are saying that we now have three categories of business in Nigeria. We have the small business, we have the medium-sized business, and we have the large business. So the small business has been categorized as business with turnover of less than 25 million naira. So as long as your turnover is less than 25 million naira cumulatively, you are exempted from paying taxes now in Nigeria. But this is premised on one, the company must have complied with other tax registration. So tax registration means that the moment you register your union, so for trade requires you to immediately register for taxes immediately. Before, it used to be a window of 6 months, but now it is immediate. Immediately the registration is done, you need to register for taxes. Now, the only time you can also enjoy this waiver as a small company is that you had filed your company income tax returns. So for the fact that your income is exempted from tax does not exempt. Now, what is returns is different from paying tax. I think this is the third time I'm mentioning that. So you must have filed your returns for you to enjoy this waiver of a small company. The timing of filing is also very important, and payment of penalty. So if you must have filed within the time frame, and if you fail to file within that time frame, you must have paid the relevant penalties that are due for filing late and not filing within the time frame required by law. Now, what other exemptions have we gotten based on the new act? Small business in a dividend received by a lender from its approved agent or borrower in a regulated security lending transaction will be frank investment and not subjected to further taxes. So let me explain what this is all about. Well, this has always been there in the law, right? It's actually called this is also called the amount withheld. So dividend is seen to be a frank income. So when you receive dividend, the company paying out dividend is required to withhold withholding tax. So remember the withholding tax I talked about in the previous slide, and I mentioned to you that we have various kind of transactions that are within the withholding tax framework. And I talked about royalty, I talked about contract, rent. So now we are looking at the dividend side of it. So when a company pays dividends, they withheld. If it's for individual, they remit the withheld amount to the relevant state where the individual is resident. And if the dividend is paid to a corporate, a limited liability company, they remit that withholding tax to the Federal Revenue Service. Now remember, I said that withholding tax is used to offset company income tax liability for the company who benefits from that withholding tax, correct? But in this case, this law is saying that yes, the person earning dividend will not pay taxes on that dividend. So dividend will be exempted from tax. It should be taken as frank investment income. But note that the amount withheld, that credit note that you collected on that dividend, you will not use it to offset your liability. You know, the reasons for that is that you had paid, you have been exempted from, that income has been exempted from tax. So the will no longer be available for you. So from tax, the credit subsequently to offset liability. Now, another income that has been exempted from taxes is agricultural production company enjoy the following incentive. So we are looking at an initial tax-free period of 5 years. So for an agricultural business, you will be an initial tax period for 5 years, which is renewable for additional 3 years. That's subject to satisfactory performance of to it that you cannot enjoy any other tax relief, just like this pioneer status I mentioned just now. You can enjoy any other relief. You know, but pioneer status is you have to apply, but in this scenario, you don't have to apply as an agricultural business. By default, pioneer status is first 5 years is free, which is from taxes is dividend received from small company in manufacturing sector in the first 5 years of operation. So basically, this is to encourage people to invest in manufacturing ventures, right? Such that whatever dividend that you as an investor receive from that venture will not be subjected to taxes, right? So basically trying to encourage the manufacturing industry in Nigeria. And we have the last one, which is dividend and rental income received by a real estate investment company on behalf of its shareholder. Now, provided that one, a minimum of 75% of dividend and rental income is distributed, and the distribution is made within 12 months, but there's a clause to it that you get a year of earning. What this means basically is trying to encourage the real estate industry also in Nigeria and the investors in the real estate industry. So what they are saying is that whatever dividend that is shared to the investors and on the rental income and the dividend, whatever dividend and rental income that is shared to the investors will be exempted from tax, especially when it is not of any Nigerian company in respect of goods exported from Nigeria, given condition that a minimum of 75% of the dividend and the rental income is distributed. So 25% is key, 75% is key condition that must distribute 75% before you can enjoy that exemption. And the distribution must be made within 12 months after the financial year end of this. Yes, what was there in the previous act in law before was that of exemption that is coming to play. So how to exempt from in manufacturing taxes is the option encouraged is that whatever from tax of the government after that areas that we can venture into and we can take real good advantage of and of the tax laws and areas where government is trying to boost the economy. So as a small business, yes, small business is that government is trying to promote small business at this time, exempting them from taxes as long as their turnover is less than 25 million naira. The agricultural producing company, the government is trying to also encourage them seriously at this time. Small manufacturing businesses these are the major highlight, and the real estate business are the key sectors that government is trying to encourage and to assist, especially as it affects tax. Affects tax. So there are other new that of expense. So let me explain what. So when they are, as much as we have income that are exempted from taxes, also we have expenses that are liable for taxes. So let me give an overview of how this play out. So it's a case of you have a business, you have income, and there are these kind of expenses government will permit you to deduct that income. We call those expenses disallowed expenses. And there are some expenses side of you to back out from your income. We call those ones allowable expenses. So the more the allowable expenses, the lower your exposure to taxes. The more the disallowable expenses, the more your exposure to taxes. The more the allowable income, the less your exposure to taxes, and the more the disallowable income, the more the disallowable, the more your exposure to taxes. So this is the way it play out when it comes to tax. So this time around, we have additional allowable expenses that the government deems fit to scale. You can take out from your income. One of it is interest on debt borrowed. Interest on debt borrowed, employed as capital in acquiring profit for the company. So when you investment that will aid increase in year 5. In year 2, whatever excess we have in year 2, we will terminate in year 6. In year 3, whatever excess we have, we terminate in year 7. So 5 years, basically. So that's what that section of the law is saying. Allowance or mandatory distribution by a real estate investment company duly approved by SEC to shareholders. So if this dividend, normally dividend is not, dividend on other kind of business are below the line item, they are not allowable for tax purposes. But for the sake of this new finance bill, for the real estate industry, they are saying that dividend and mandatory distribution by real estate investment company will be allowed as an allowable expense. So for the real estate guys also. Now, the last part of it is interest paid by a lender to an approved borrower. Interest by a lender to an approved borrower in a regulated security lending transaction. I think that is pretty straightforward though. So interest paid by a lender to a borrower in a regulated, it has to be in a regulated security lending transaction. If it's just lending between two friends, between two business owners, it will not be allowable for tax purposes. Renewable financial 3 years. So allowable expenses. So we have other expenses now that are disallowed for tax purposes. Now, any expense whatsoever incurred outside or within Nigeria involving related party as defined under the transfer pricing regulation, except to the extent that it is consistent with the transfer pricing regulation. So I will explain this. So we have a lot of complaints that have related parties. So it's also exporting and the plant and equipment and complaints like let me give an instance like Kappa and Diabato. Kappa and Diabato is a related complaint to plant people street where a risk in Oregon as an advantage of that government is to encourage real estate taxes on their board. Profit education inflation incurred, right? Dividend to or the interest would be disallowed of the transfer pricing regulation. So I don't want to dive into that because this really does not really have much impact on small businesses, but we are constraining ourselves to SMEs this time around. Now, moving to the next one. Any expenses incurred in deriving tax exempt income. So there are startups that go all the way to get exemptions from government because of their nature of startup. So what you are saying there is that whatever expenses that were incurred in achieving this exemption will not be allowed as an allowable expenses. So it will be disallowed for tax purposes. Now, laws of capital nature. Laws of capital nature. Well, for me, this seems to be open-ended because what is the definition of capital nature? Are you getting it now? But again, gradually FRS, which is the administrator of this act, they've started coming up with their exposure draft on how this will be administered. They released the exposure draft for the implementation draft for value-added tax about last week, and the implementation draft is still coming up. So we'll see how this is going to unfold in their implementation draft as it come up. So this for me right now, it is still open-ended until we see the implementation draft. So the next one, any expense allowable deduction under CGT. So CGT is capital gain tax. I explained capital gain tax earlier as the tax that is paid on the gain of the disposal of fixed asset. So assume when you are disposing that asset, you incur legal fee, you incur marketing fees and all that. If you remove, and I said that the cost of that asset, all the expenses to that asset, you back it out, and whatever profit you gain is whatever profit that is left, you charge 10% capital gain on it. So the legal fees and the marketing fees for selling that asset is not allowed as a deductible expenses anymore for when you are doing your tax workings as a business, as a company. Now, remember in the previous slide, now the next item is dividend. Dividend has never been an allowable expense before at any point in time. But going back to this slide, where we talk about the this time we talk about the real estate guys, they've granted to the real estate that they can take it out as an allowable expense, but dividend remains allowable expense for every other kind of business. Is it never an allowable expense except for the guys in the real estate for now? Now, the next one is interest from an approved agent in a regulatory security exchange transaction. So a lot of financial activity happen these days. So the way this applies is we have people that come around to say, okay, you have shares, give me your shares, and give me your shares, let me trade with it, and they are giving a deposit of the value of the equivalent value of the shares. This is talking to the financial market basically. So FMDQ transaction and the rest of it. So Mr. A got Mr. B's shares of about, say, 100 million or 100 million, for instance. Before collecting those shares, you must have dropped the cash equivalent with an agent, right? Who is going to an agreed agent between two parties, the equivalent of that with an agreed agent. There are so many kind of transaction, arrangement, and structure that come up in this kind of financial setting. I'm just giving a light scenario. So Mr. A is about to trade with Mr. B's shares. He has gotten Mr. B's shares, but before collecting the shares of about worth of 100 million, he has dropped the equivalent of cash equivalent of 100 million with an approved agent of the two. The agent is not just holding that money aloof. The agent is also investing that money on something, say for instance, fixed deposit or short-term deposit. So whatever interest that accrues from that money, of course, will back to whoever is the beneficiary of the money, depending on the arrangement that is on ground. Now, any money this agent, any interest this agent is paying back, right, to whoever is the beneficiary of that interest, that interest is never an allowable expense in the hands of the agent when the agent is paying to whatever beneficiary based on the arrangement that is on ground, because the agent is just a third party within that transaction. He is holding the money in lieu of the other two parties. So whatever interest is paying to whoever is the beneficiary of the interest, the agent cannot take that interest as an expense, as a taxable expense or an unallowable taxable expense in his own books. You understand? So let's move on. Any penalty prescribed by any act of National Assembly for violation of any status. So basically, this is coming here because of this MTN. You remember the MTN case when they fined the God for, and they tried to expense it when they were when they were doing their tax returns, and it became an issue between FRS, the Ministry of Finance, and MTN. They went to the court tribunal. They've exited tribunal right now. They've settled out of court, but now it is now a law that should that happen in the future, it is not going to be an allowable expense. The reason why they have to go to tribunal is because it's not explicitly stated in the law before. So they needed to get clarification from the court. But they settled out of court. Now it is in the law that is a disallowed expense. Now, any tax or penalty borne by a company on behalf of another company. So I mentioned issue of Kappa and Diabo earlier on as a related party. Kappa and Diabo and Clay. So if Clay incur expense on behalf of Kappa, it will never be an allowable expense in the books of Clay, right? It will be disallowable expense in the books of Clay. That's basically what it's talking about. So if company A and company B is a related party, you cannot incur expenses on behalf of each other. Are you getting now? And this still boils down to the foundation I talked about earlier on, proper bookkeeping. Proper bookkeeping. If the books are well kept, are you getting it now? Things will not be up at any point in time, even if there are related party at any point in time. So, this is not a section of trying to of a task class calculation or what have you, but I'm just trying to bring us up to speed with development that has happened over time especially with this finance bill. So the computation process of the computation process of a complaint has changed slightly. So when a business starts operation, we call something commencement rule. Commencement rule in the past used to overlap. So we used to have situations where if a company commences business in March and the year end is December, government has its own year end from January to December every year. So effectively, the company's period of account eventually will be different from that of the company, especially when the company chooses to have a different financial year end. Say, for instance, the company picks September as its own year end. So if a company now sets its own end as a government year end, which is always December, we have a lot of overlapping and we do a lot of adjustment in the past. But that has changed. So the new law is saying that in year one, as against what it used to be, in year one, the profit from the date in which it commenced to carry on such trade or business, the end of the first accounting period. So the first accounting period will now be the company's own accounting period. So if the company choose to have its year end to be September, then it start operation in February. So it then means that your first profit that will be subjected to taxes will be from February to September of that same year. On such trade, that will be your first year of tax computation. Now, the second year of tax computation will be the profit after the first day of the first accounting period to the end of the second accounting period. So if we have a situation whereby you started operation in February, you've chosen your year end to be September. So your first account will be from February, or your first tax working will be from February to September. Your second tax workings will be from October that same year to September of the following year. So that is the way the law has now changed as against what we used to have in the past. One third year will be the profit of the immediate period that just ended, which is also October of the following year, up to the next September. So basically, this time around, we don't have that headache of overlapping and overlapping. The overlapping that we used to have before accumulate losses on the company, and sometimes if there's a profit, making the company to pay what naturally shouldn't have paid in form of taxes. This time around, this overlapping thing has been eliminated. So we move on to another side of the law that has changed, which is cessation. So when I just talked about commencement, when a company is just commencing operation, and cessation is when the company is winding up. So if the company is winding up, law is now saying that total profit shall be the amount of the profit from the beginning of the account period to the date of cessation, and the tax thereof shall be payable within 6 months. Now, the second of September cessation. So, if you are ceasing operation, let's continue with the example. If year end normally is September, and we are ceasing operation, say, with this time around, we don't have the profit that we need to subject that has changed, which is cessation of that year, whereby we cease we are ceasing operation. Say, for instance, in June the following year, we cease will have to be paid within 6 months of that date that the business ceases operation. So that's the new rule. Now, minimum tax has also changed. All this affects SME because so what is minimum tax? I said earlier on that you have to file your returns. Filing returns is different from paying of taxes. So filing of return different from paying of taxes. So let me read through this statement we have here and I will explain better. It says minimum tax to be levied and paid shall be 0.5% of the gross turnover of the company, less frank investment income. The following are exempt from minimum tax. 1, a company carrying on agricultural trade or business. A company with turnover less than 25 million, that's a small company. And a company in its 4 years of business commencement. So every company is expected to file returns, but there are some things that will exempt you from paying anything should there not even be tax liability. But should there be tax liability, you just have to pay minimum tax. So if there is no tax liability, right, you have to pay minimum tax. Before, we used to have computation of calculating minimum tax. but now it has been simplified. Minimum tax is 0.5% of your gross turnover. That's it. And you less all the frank investment. The frank investment are the dividend. I mentioned that earlier. You back it out, right? And other kind of frank investment that comes on board. So when you back all that out, you charge the 5% on it. Then that is your minimum tax. But you will not be subjected to minimum tax if if it's an agricultural business. If your company is a small company, you will not be subject to minimum tax. And if your company is still within the first 4 years of operation, you will not also be subjected to minimum tax. These are the exemptions of minimum tax. But as long as you don't fall within these exemptions, right? And after doing your tax workings, your computation shows that you don't have a tax liability, compulsorily you have to pay minimum tax. I chose to speak to this particular section of the which is section 29, because I know that a lot of SME too are going into gas utilization, which is the downstream operation of the oil and gas industry. So within the oil and gas industry, we have the upstream operation. The upstream operation is managed by the Petroleum Profit Tax, right? Petroleum Profit Tax Act is managed under the upstream operation of the oil and gas industry. The downstream operation is managed by the Company Income Tax Act, is within the Company Income Tax Act. Under that, we have this gas utilization. Well, the only reason why I brought this into this discussion is because of a lot of SMEs that are going into gas activities in recent time, for them to be able to see that there are other benefits, that there are incentives within that sector of business that they can enjoy as a result of that they can enjoy in tax-wise. So one of those incentives is that an initial tax-free period of 3 years, which may, subject to the satisfactory performance of the business, be renewed for an additional period of 2 years. So you can enjoy incentive without even applying for it, like a pioneer status thing. Do you understand? Apart from that incentive, you can enjoy plus accelerated capital allowance after the tax-free period. So what is capital allowance? Let me explain capital allowance. So we call something depreciation in accounting. Depreciation in accounting, the replica of it in tax is capital allowance. Do you understand? So in accounting, when we say depreciation, which is a general word, depreciation. Depreciation means the write down in value of an asset. So if you purchase a motor vehicle for 1 million naira, you want to depreciate it for like 4 years. So every year you want to write off like 250,000 naira from that motor vehicle. So your write-off is more or less like taking that write-off from whatever income you made. So you made an income of 10 million, you write off. You made an income of 1 million, you write off 50 in the year. So you made a profit of 750,000, right? Now, the depreciation there is the same thing as capital allowance for taxes. So I'll not go into the calculation. Like I said, we are not in tax class. So I'll not go into the detail in calculation. But what the law is saying here is that you enjoy this tax-free period plus accelerated capital allowance as follows: an annual allowance of 90% with 10% retention of investment in plant and machine. So instead of taking just 250,000, which is just about 25%, the law is granting you 90%. That's why it is called accelerated capital allowance. Do you understand? Additionally to that is an additional investment allowance of 15%, which shall not reduce the value of assets. So you see, this percentage that you have to enjoy that will further help you to reduce your tax exposure because you've invested in this line of business. You have a tax-free dividend during the tax-free period. So your dividend you are paying your investors or the shareholders will be tax-free for this period, right? Where investment for the business is in foreign currency and the production of imported plant and machinery during the period was less than 30% of equity share capital. So you cannot enjoy, there are twofold of the benefit that you can enjoy. Is either this first part or this other part of the benefit. But again, what is new to this particular section of the law? This incentive will not apply to companies that has claimed or wish to claim the incentives under the Industrial Development Industrial Development Act, that income tax relief act, in respect of same qualifying capital expenditure. So this is the only line that has been introduced to this particular section of the law, that it will no longer be applicable to anybody that has enjoyed any relief under this particular Industrial Development Act. That is pertaining to Section 39. Okay, tax rate has changed. Tax rate has changed. Tax rate has changed from before now. The tax rate of company income tax is 30%. 30%, and we have education tax of 2%. But now tax rate has changed. So for the small guy, for the small company that has turnover of less than or equals to 25 million, no longer pay taxes. If your income is within this bracket of less than 100 million, you are paying 20% on CIT. So your tax rate is now 20% if your turnover is less than 100 million. But if your turnover is above 100 million, then you are paying 30%, still the old rate, as taxes. So that's the position as it is right now on the tax rate. So time to pay tax, I think this is the most important side of for SMEs in my view, because time to pay and the time to file, these are very key things for SMEs, because what kills SME penalty that they tend to have to pay at the end of the day, and especially for the people that will not want to do things that are unethical, right? The only option is probably just to wind down the business somehow and just forget about the business name, and that has a lot of effect and impact on the company. So before now, we used to have something called provisional tax. Let me explain that provisional tax, and for those that have been involved in it before. So if the law requires you to file your taxes 6 months after your year end of business. So if your financial year end is September, our oldest September, your year end. So the law requires you to file your account 6 months after. So 6 months after will be about, I think, March the following year. So it will be September, October, November, December, January, February, March. It's March. March the following year, you must have filed your account and you have a grace period of 2 months to pay. But a lot of complaints, due to one reason or the other, they always envisage that it's possible they are not able to file within that time. They will not be able to pay within the time frame. They tend to pay provisional tax. So provisional tax is just like the tax you pay in the previous year, 2019. If you paid 9,000, 900,000 in 2019, in January 2020, go and pay 9,000 the government covers. That is what we call provisional tax. So pending the time you do your account and you prepare your tax work. So when you prepare your tax work, if your tax liability is above that 900,000, you pay the differential and you file, and you are not subjected to any headache writing of letters from the tax office and the rest of it. But that section of the law has been deleted. Now, what do we have that is new within this framework? Every company shall make payment of tax due on or before the due date of filing in one lump sum or installment. So at the time you are filing in, you must pay up everything in one lump sum. Unlike before, that they give you, there's a grace period of 2 months after filing. 2 months after filing to make payment. This time around, you must pay immediately when you are doing your filing, right? One lump sum or installment. If you want to do installment, then you must have started that your installment from January or from the very first day your financial year ends. So let's take for instance your financial year ends in September, right? Your financial year ends in September. So you want to pay in installment. Again, there's no way you must have been able to define what your liability will be because you've not done your account and you've not done your tax workings. So you can write to the tax office to say that, you know what, I would like to pay my tax liability in installment. I am paying down just something like the provisional tax. I am paying down 200,000 naira, right? And I would like to pay the balance in this other installment. So you then start to pay that installment until the last day when you pay final installment. Basically, government is saying that we need the money like now, and we don't want you to hold on to money. That's what the government is basically saying in this new arrangement that has been provided. But again, government has also given a kind of a window those that will be willing to pay up on time as kind of incentive for people to pay up promptly. So one of the incentives they've given is that payment of tax within days from the due date will enjoy a bonus as follows. So if you are a medium-sized company, you enjoy a bonus 2% of the tax liability you are meant to pay. But that bonus of 2%, you will enjoy it in the subsequent year. So you pay the full amount now. When you are doing your tax work in the following year, you back it out from that liability. Why for every other company, you enjoy 1% for the every other company? Of course, small company is not paying taxes anyway. So late returns penalty remains the same. So for your first month of default of filing your returns under company income tax, it's still 25,000 and 5,000 for every other subsequent month of not filing. Well, this is a major thing I advise SME. Try and be compliant and stop wasting money paying penalties to government. So I will dive to value-added tax. What has changed under value-added tax and what is in the importance of compliance for small businesses? So before now, we used to have value-added tax used to be 5%, but that has increased to 7.5% on all vatable goods. Some goods are exempted from VAT, charging of VAT. Quick example I can give to you right now is baby food, baby clothes, baby things are exempted from value-added tax. Things that are direct, that produced direct from the soil, especially agricultural produce, like cassava. The farmer that's bringing out that cassava product from the soil is exempted from charging value-added tax. Some of these exemptions it's quite much, right? But we need to be able to identify, are we trading in that business that we are not expected to charge VAT, right? So let's move on. So there's a 6-month window for VAT registration has been removed, and registration is now immediate. So the VAT registration thing still remains your registration for taxes, your TIN number, and I mentioned it earlier. Immediately you get your CAC documentation, the law is now saying that you have to go and file. You have to register for tax immediately. The window of 6 months has been taken off. There's no more window of 6 months of registration. Failure to register within this time frame attracts penalty of 50,000 naira. So if you don't have a need to run a limited liability company or to have a company or a business name, just don't go and open a business name for the sake of opening it and don't register for taxes. Are you getting what I'm saying? There's no point. Don't just waste your money. If you want to register with CAC, you must get that TIN number. Failure to do that, you will start paying 50,000 naira in the first month of default, and in the subsequent month, you will be paying 25,000 naira. And remember, You cannot open a bank account without this TIN number. You understand? So you will have only wasted money with your lawyer registering a company when you fail to register for taxes immediately. Because by the time you choose to register for tax after 2 years, you must have accumulated millions of naira in penalty, and I don't think anybody wants to do that. So the only best thing is for you to abandon that registration and move on with another registration. But the advice is this: immediately you register a CAC, immediately go and register with the tax office to avoid this penalty. Before, it used to be 10,000 naira, 5,000 naira subsequently, but now it is 50,000 naira. It shows that government is becoming very serious as relates to gas taxes and people being compliant and registering for taxes. Okay, we move to the next one. In the event of trade or business cessation, taxpayer must notify the tax office within 90 days. Failure to notify will simply attract penalty for not filing. So, failure to file, we will see the penalty subsequently. The failure to file will see the penalty. But what is it saying? That any day you cease operation, you should immediately notify the tax office that you had ceased operation. Otherwise, the failure for not informing them translate to failure for not filing your VAT returns if you are not within the bracket of small business. Now, non-resident company business in Nigeria will have to pay VAT through the product beneficiary in Nigeria. The Nigerian company will invariably suffer the VAT consequences. This has always been in the law, but what is changing is that local company must withhold the VAT and remit on behalf of the foreign company. So this has always been a major issue in practice in the past. So we have foreign guys that does a lot of foreign company does business in Nigeria. Good example is Amazon, right? Amazon, you go on Amazon online, you buy, right? And Amazon gets credit over there. They send news to the beneficiary in Nigeria, and that ends the deal. Amazon has actually done business in Nigeria, but government is now saying, you know what? Amazon must pay tax in Nigeria because it's actually doing business in Nigeria. Yes, it's not fiscally present in Nigeria, but Amazon is doing business in Nigeria. So how will the government then get its own taxes? Well, government can hold on to Amazon, but the person who is doing that business in Nigeria, who is the beneficiary of that transaction in Nigeria, will be the one that will have to pay the VAT consequence of that transaction. You know, this is for me, this is a challenge for SMEs because they practically now saying, they have to burn that they are not meant to bear naturally. But as long as you are outside the framework of small business, are you getting it now? This automatically applies to you. But if you are within the framework of small business, then you are exempted from this narrative of this section of the law. Now, company with annual turnover of less than 25 million will be exempted from VAT. So 25 million, that's small company. You are now exempted from VAT. So what does this mean? This means that you don't have to, small company don't have to file VAT. And I'll explain how this works. The FRS have just released the operational guideline on how this is going to apply to SME. So the question is, how do we then identify a small company? Now, we are in 2020. The account, if your account for 2019 is less than 25 million, then you are a small company. In 2019, I'm repeating myself, in 2019, if your turnover is less than 25 million in 2019, yes, you are within the framework of small company in 2020. Now, in 2020, the moment you raise a single invoice that is above 25 million naira, you have to charge VAT on that invoice. You are no longer a small company. Or the moment your accumulated invoice hits 25 million, subsequently, you must immediately start charging value-added tax on your invoices, because at that point, you are no longer what? A small company. Now, who pays the VAT of a small company? A small company issues 100% invoice to his what? To his customer. Now, the customer who is not a final customer, let's assume you are just in between a value chain and your customer is, let's say, a Nestle, for instance. If your customer is a Nestle, for instance, right? Nestle will be the one to charge that VAT and remit on your behalf to the Federal Inland Revenue Service. So here is how it works. SME will enjoy, especially for those dealing B2C. B2C for SMEs, for small company, will enjoy charging their final consumers value-added tax. Now, why? Because they are exempted from charging VAT. But if it's a small company that is servicing a big company, that's B2B, now, then it is a big company that will go and pay the VAT. Naturally, the small company should have charged VAT anyway. The big company should have paid the VAT anyway. So, but the big company now will have to pay that VAT by itself on behalf of the small company. So, FRS, so lifting the burden off the small company, right? But if the moment you hit 25 million of your invoices, you have to start charging VAT. It then means that you are no longer a small company. Now, disposal of assets and sales of whole or part of business is now exempted from value-added tax. I move to the next one. Tax credit against subsequent month under VAT. Tax credit against subsequent month. So I'll come back. Let me quickly come back to this disposal of assets. So before now, the tax guy always want to tax your assets. So you are in the business of selling baby food. Of course, you have assets of motor vehicle and light that you use in running your business. When you sell that motor vehicle, before now, the tax guy will say that you should have charged VAT on the sales of that motor vehicle. Well, this time around, the law is split to say that the disposal of that motor vehicle is exempted from value-added tax, because that is not your ordinary cost. That is not your ordinary business. Your ordinary business is selling of baby food. The selling of disposal of car is just as a result of the car is now scrapped. So it is now exempted from VAT. Now, tax credit. What is tax credit under VAT? Tax credit means, I explained something earlier on when I talked about the guy from the cassava guy, the processor, the store, and the final consumer. So that is just online transaction that I've explained, right? But there are instances whereby the VAT that you charge that month. So that's just the way it works. And that has been the way it works before, even before now. But now they've just practically implemented it within the tax law, because initially it was not in the tax law before in this format. Now, penalty for non-remittance has increased to 10% as against 5% and per annum, plus interest as CBN minimum discount rate plus a spread to be determined by the minister. So this is a penalty of failure to remit what you've received in form of VAT, and they come for tax audit and they discover. Failure to remit is different from failure to file. So if you are within the VAT bracket and you fail to file your value-added tax, you will be paying 50,000 naira for the first month of default and 25,000 naira. In practice, I have seen businesses going down because of penalties that cannot be paid. See, if you fail to file your returns in 1 year, with this new law, you will be exposed to liability in 1 year alone. You will be exposed to liability of about 2.something million. I don't think any SME wants to go through this ordeal. So it is cheaper to comply, while it is more expensive to never to comply. Well, some people will say that it is Nigeria, but I keep telling everybody, Nigeria is gradually changing. Government needs money, and they will squeeze out that money anyhow from business. Now, the next line says failure to file VAT returns is now 50,000 naira, which is what I just explained. It's now 50,000 naira for the first month, and subsequent month is 25,000 naira. Also, failure to notify the tax office of change of address. Change of address. So you change your business address. You used to be in Ikeja. You are now operating from Lekki, and you fail to notify the tax office of your change of address. Also attract the fine of 50,000 naira in the first month of default and subsequent month of 25,000 naira. I don't think anybody want to pay this. Okay. In the event